Good afternoon. Welcome to Midcap Radar. I'm Reema Tendulkar. With me is Sonal Bhutra, and these are the top stories at 1:30 p.m. Markets extend losses to trade near the day's low. The Nifty falls below 17,550. The sensex sheds over 1,000 points. The Nifty Bank is the key drag, with the index down 3%. The Midcap index falls 2%.
Adani Group stocks take a beating on research firm Hindenburg's report projecting a 85% downside in the group stocks.
Banks underperform. Midcap banks like J&K, Union Bank, Bank of India, Bank of Maharashtra lead the fall with a 5 to 10% decline.
Dixon Technologies slumps 19% today after missing sales expectation and trimming its guidance. Indus Towers slips for the second day in a row, down over 13% on receivables risk from Vodafone Idea. Okay, those are the headlines that we are tracking, but the key headline definitely is the fact that the markets have fallen and there is no respite which is in sight, because right now Nifty is sitting with cuts of around 340 points. It's a 1.9% cut on the benchmark index, and the Bank Nifty is the one which is underperformed with cuts of around 3%. At the day's low, there was an attempt of recovery, but that has been sold into. And big Nifty names, they are falling around 18 to 20%. Of course, those are the Adani Group stocks which have taken a beating today. In the broader markets as well, there were no signs of any any recovery from the lows, so to say. And Reema, we have been seeing it for last two trading sessions. On Friday as well, Bank Nifty was the underperformer. In last couple of 2-3 trading sessions, Bank Nifty is around 6%. So definitely a lot of pressure.
Absolutely, almost capitulation, right?
Yeah.
The way you're seeing the broader markets also collapse. The advanced decline ratio has one stock in the green for about 9 to 10 in the red. So you've got about less than 300 in the green to about 2,700 stocks currently in the red. So there is widespread decline that you can see. And these are two back-to-back very large days of decline. On Wednesday, the Nifty fall was 225 points. We followed it up with a 325-point decline. Even in the mid-cap banking space, the fall on Wednesday was, I think, close to about 1,200 points. It's down another 1,300 points today. The levels, it's just some important levels as we've been highlighting. Currently around 17,500 is the 200-day exponential moving average. Currently, we seem to be finding some support there. Below that will be the 200-day simple moving average, which is 17,290. If that is also breached, then the next level to track will be the September-October low, which is 16,750. So these are some levels that you should keep on your mind. Bala of cashthechaos.com is the man who's going to be telling us how we could proceed from here on. Jay, you've been very bearish on the markets. I remember in a couple of conversations back, you had indicated that it will not be surprising if the Nifty even goes back to the June low of 15,300. There is a seminal decline on our hands now over the last two trading sessions. What are the technicals suggesting for the near term and medium term?
Yeah, thanks for having me on the show, Reema. The markets are coming to a very important medium-term support level of 17,428. And that's the last fuels of hope for the bulls. If the market were to print 17,428, there are no bullish options left for the markets except to go below the June low of 15,000 odds. And that's the medium-term outlook. From a short-term perspective, the IVs for the markets are quite low. If you look at the derivative markets, the markets are going into February, the budget, and as well as the Fed meeting. And the IVs are quite low, so that's not quite helpful for a bullish case too. And, we could see extreme short-term bounces come through. But, they're very clearly on a sell-on price markets. And these short-term bounces are likely to be very fleeting.
Just one quick, understanding. Why is 17,428 such a critical support for us?
It's a Elliott wave technique that I use, and so it's a bit too technical to to get into that at that moment. Okay. So I won't get into it. So I just leave it at the point that it's just a technical setup.
Okay, so that's the technical setup. Any sector or any pocket that you think would see some recovery from the lows, Jay? Because even Bank Nifty, we've lost around 6% in last couple of trading sessions. What's the outlook on this index?
See, Bank Nifty has got considerable downsides to work with. ICICI and SBI are going to be leading the way down. And if you look at the pocket that might outperform. I've been saying it will be IT. And even in IT, we've got to be very specific. And in IT, I like persistent and Coforge and HCL Tech to an extent. HCL Tech to a lot less, but the order in IT is this: Persistent first, then Coforge, then HCL Tech. So, there are pockets, but, the pocket that will outperform, in my opinion, is going to be cash. If you go to cash now, you'll be having the same portfolio, and a few months down the line, you'll also have a lot more cash and the same portfolio. So, you want to, it's not too late to go to cash even now. I've been saying that you should go to cash, several weeks ago, but even now it's not too late. Use the bounces to exit.
Okay. On banks, you had indicated that 40,800 is an important support. Now we are trading well below that level. We're currently at about 40,300, in fact, even lower than that. Does the bank Nifty decline further from here on?
Yes, definitely. See, Nifty is not going to go down on its own, and the bank Nifty is likely to stay afloat. That's not going to happen. The bank Nifty is also going to go back somewhere close to the June lows. It could probably, slightly, outperform in that relative sense, but, much lower levels are expected for, the banking index. The ICSA has got a heavy weight on the bank Nifty, and SBI is the top weight for the banking index, and each of them are likely to decline about 20% from here, but that's not on the immediate basis, but probably, several weeks to a couple of months from now.
Okay. Jay, that is about the bank Nifty. And you also spoke about how you see some recovery, at least in the Nifty IT. But what's your take on the Nifty auto sector? Because, the numbers have been good. Fundamentally, of course, that space is looking better. Technically, how do things stack up?
Yeah, the bank Nifty the bank Nifty auto is managing to stay afloat, important support, but, it's an exhausted trend. We had a topish pattern a couple of weeks ago. Even if the bank Nifty auto were to make its fresh 52-week highs, it will be an exhaustion top. And you might want to use that as an exit opportunity. When the sentiments turn sour, very, very unlikely that any sector will be left, doing something like swimming against the stream. The stream is flowing down. You can't, swim upstream. It's quite difficult. You can't sustain that for long. So, you might want to use these bump ups as exit opportunities.
Very quickly, Jay, is the risk reward favorable to go short now? Because we've already fallen more than 500 points, and the support level that you're watching, 17,428, we're just about 120 points away from that. At the current juncture, is there a trade?
It depends on what time frame you are looking to hold for your short. If you are looking to roll it over, yes, definitely there are opportunities here. But from if you're going to be holding for the immediate Thursday expiry, I think that will be a little bit late. So you might want to wait for a sort of a bounce back for the markets to come through, and then use that for shorting for the extreme short term. But if you're a trader who can roll over contracts for a couple of months, then definitely there is still opportunity. But even there, you want to wait for building up your position on a rise, not exactly at the current position. You might want to take up small positions right now, but on a rise, you want to build further positions.
Okay, all right. We take that point, Jay Bala. Thank you so much for joining us with that technical check on the markets, of course, important on a day like this. And that's, of course, because of the pressure that we are seeing on the Adani Group stocks and those